Morning, it's Nick with Us versus Herd. Today I want to go through some of the rules that I use when trading during earnings season, not only to make money, but also to protect myself, because as you know, earnings season is a lot of unknowns. Anyone can say anything, the report can say anything, even if the company is doing well, anything can happen. And that's why I'm going to stick to these rules and kind of go through them with you on the ways that I protect myself, because I don't just trade anything. With earnings season, you could trade literally anything. I mean, hundreds of companies report a day, sometimes, thousands a week, and you can go in there and just, gamble all your money till it's zero. One of the things is, if you don't know what earnings season is, definitely don't trade it. Get familiar with the stock market, get familiar with trading options before you go in and, you make a trade not fully understanding, or making a trade on a day that's earnings and you don't even know it's earnings. I've had people hit me up before saying, hey, I just made this trade. You think I should keep it? And I didn't know what earnings is. And, it's a disaster. So if you don't know what that is, educate yourself, Google it. Very simple. One of the things that I do, there's premium selling and there's premium buying. Most times when I'm trading earnings, I'm selling premium, mainly because it's a lot easier to make money. One of the reasons why is because of IV rank. If you look down here in my chart, I have Netflix. Netflix actually reported earnings today. Netflix, down below I have this implied volatility chart, kind of shows you right before earnings, implied volatility is up, and then when they come out the next day, it drops. So premium sellers definitely take note on that. They make money on that. And same thing with here. As you can see here, earnings came out, went down. Same thing right here back in April. Implied volatility was up, and then it dropped like a rock. And it came out today, and implied volatility will probably be back down here into the 30s after tomorrow. One of the rules that I trade by is if I believe it's going to be greater than 5%, I'll be a premium buyer. If I think it's going to be less than 5%, I'm going to be a premium seller. Most times I'm looking for a neutral position, or kind of a skewed position to the bullish side, or to the bear side. So it depends on what you're trading here or what you're looking at. But let's say for Netflix, for example, let's go back to here. In October, if you were a premium seller, look, the stock barely moved, you made a killing. I think they were pricing it in at like a $20 move. And if you say, hey, how do I know what the move is going to be? You go to the option chain here, and in the upper right hand corner, it'll tell you right here. I'm going to open up this option chain here. It'll tell you what the expected move is going to be a plus or minus $33. So the market was pricing in and going to be up or down $33. Let's look at what Netflix did after hours here. It was close at 400. Go to the 15-minute chart here. Yeah, all right, 400 went down to 342. So I think it had like a 13% drop here. I think maybe this is like 13%. So way greater than the 5% move. Now, if you bought premium down, if you bought puts, like far out the money puts, you're probably making money. We can go to the option chain here and kind of take a look here. So it closed at 400. So 400, these 400 puts were going for 1650 at close, and these 345s were going for $1. If you bought these far out here, you're probably making money. Now, you're not going to be making, if you're like, oh, I'm going to make $16 on this, or you're going to make $15 on that, being $1. Probably when this opens up tomorrow, it's going to be probably $7 or $8 at the most. You're not going to be here, and the reason why is because of that implied volatility. It's not going to be $13, $16 unless you're deep in the money. And these cheapos down here, they're still out of the money. So, but let's say you bought this 345 down here, it's probably going to be around $500-600. You'll make 500%, 400% on that, which is a great return. But earnings don't move like this every time, and to identify the ones that do, it's difficult. That's why it's a lot easier to become a premium seller. Now, if you're selling calls, you're making money, but if you sold puts, you'll be losing money. And at the end of the day, somebody's always going to pay somebody. So just being on the right side of it and knowing the strategies they have in place. Most time I look for stocks that aren't going to move a lot but have high IV rank or high implied volatility. And the reason why I do that is because I really try to take advantage of this IV crush like this. We made a lot of money on this play right here when it didn't move a lot, and IV got totally crushed, no movement, and those options expired or worthless, or got crushed to the point where we made almost max profit. You're making 80 to 90%. So the one thing that when you do sell premium is you're not making as much money, but you're making more consistent money. So if you're trading in the market, it's not about how much money you make, it's about how consistently you are making it. So that's why I try to sell a premium. The one time that I will say I did buy premium recently, a couple quarters ago, was on Twitter. Twitter, they were having, they've been in the between $15 and $20 range for a long time, a couple of years, and they were riding the struggle bus down here. And then they started to say, hey, we're going to become profitable in the next quarter or two. Keep note. So I bought some far out of the money calls on Twitter. And because I knew, like, if they say they're going to be profitable, it's not like some Tesla Elon Musk thing. This sounds legit. So I'm a stockholder of Twitter, so it's something that I trade a lot or I buy a lot. I have stock. I do trade options on it quite a bit, so I'm familiar with how it moves. And it was moving in a very bullish direction. I mean, it had some nice climb here, and had some pullback, and then it climbed again, and had some pullback, and then it climbed again. And as you can see here, it's been pretty insane moves this year. But on this one, I bought them for 50 cents. I bought two calls for 50 cents, kind of far out the money. I think I bought the $30 strike, and it opened up around 32. But I bought the September ones, I believe, or the far out. I think it was like 5 or 6 months out from this was in February. So I think I bought September calls or August calls, kind of say, hey, if when buying premium, if I don't really buy the ones for this week, mainly because if it doesn't work out, I can hold them. So if I buy premium far out the money, I'm going to buy something that's 6 to 9 months out, because if it does go against me, I'll get a chance just to hold on to it. And as you can see, if it did pull back like it did here, it did come back up as well here. So when you're buying premium, you definitely want to give yourself enough chance. When you're selling premium, you want to give yourself less time, so that way the Ivy Crush really helps, and then the Theta really helps you as well, and you get those inflated prices to be come under you. So those are some of the options, some of the rules that I use when trading options during earnings. I hope that helped. If you have any questions, definitely leave them below. Hit up our social media profiles. I'll leave a comment. I'll leave a link for those below as well. Like and subscribe to these videos. We'll have more on the way.